Person buys real estate, the other buys index funds. 20 years later, one has tenants, properties, mortgages, repairs, and a portfolio worth millions. The other has a boring investment account that barely anyone knows exists. So which person wins? Real estate or index funds? The answer is more interesting than you think, because both can create generational wealth, but they do it in completely different ways. And depending on your income, personality, time, and ability to handle debt, one may be dramatically better for you. The real estate person. Let's start with Sarah. Sarah has $100,000. She wants to build wealth through real estate, so she doesn't spend the entire $100,000 buying a property. Instead, she uses it as a down payment and reserves. She finds a $400,000 rental property. Now something important has happened. Sarah controls a $400,000 asset with $100,000 of her own money. That's leverage. And leverage is one of the biggest reasons real estate can build wealth so quickly. If that property rises 5% in value, Sarah doesn't earn 5% on the $100,000 she originally invested. The property increased by roughly $20,000. That's a 20% increase relative to her original $100,000. Before considering interest, taxes, maintenance, transaction costs, and other expenses, this is where real estate gets powerful. You can control a large asset with a relatively small amount of your own capital. But there's another layer. The tenant is helping pay the mortgage. Over time, part of that rent is effectively converting into equity. So Sarah potentially has three engines working at once: property appreciation, loan principal reduction, and rental income. And if she manages the property well, there can be tax advantages too. Depreciation can reduce taxable rental income even when the property itself is appreciating. That's a powerful combination. But here's the part people leave out of the Instagram version of real estate. Leverage works in both directions. When real estate goes wrong, imagine Sarah buys that $400,000 property. Then the local market falls. The property becomes worth $320,000. Sarah didn't just lose 20% of the property's value. Her equity could have taken a much larger hit because she used borrowed money. And the mortgage doesn't care that the property fell. The bank still expects its payment. Then the roof needs repairs. The tenant leaves. The water heater breaks. Insurance goes up. Property taxes increase. And suddenly Sarah isn't just an investor. She's running a small business. This is the hidden cost of real estate. Time. Real estate can build enormous wealth, but it often demands attention. You have to find properties, analyze deals, manage tenants, handle repairs, understand financing, track expenses, and sometimes deal with problems at exactly the moment you wanted nothing to do with them. That's not necessarily bad. In fact, some people love it. But you need to understand what you're buying. You're not just buying an asset, you're buying responsibility. Now meet David. David has the same $100,000, but he doesn't want tenants. He doesn't want to fix toilets. He doesn't want to negotiate with contractors. He wants something boring. So David puts his money into a diversified low-cost index fund. No tenants, no roof, no midnight phone calls, no property manager. Just ownership of a broad collection of companies. And then he does something incredibly difficult. Nothing. He keeps investing. Every month, year after year. When the market goes up, he buys. When the market falls, he keeps buying. When the news says the economy is collapsing, he keeps buying. When everyone around him is suddenly talking about the next hot investment, he keeps buying the boring thing. And this is where index funds become extremely powerful. They don't require you to find the perfect property. They don't require leverage. They don't require a tenant. They don't require you to predict which company will dominate the next decade. You're buying a diversified slice of businesses and letting time do most of the work. The compounding battle. Now let's make the comparison simple. Suppose David invests $100,000 and earns an average hypothetical 8% annual return for 30 years without adding another dollar. That $100,000 grows to roughly $1 million. Not because David found a secret investment, because compounding had 3 decades to work. And if David continues adding money every month, the number can become dramatically larger. This is why index funds are so powerful for ordinary investors. They are boring enough to hold. You don't need to manage them every Tuesday night. You don't need to answer a tenant's phone call. You don't need to refinance a building. You need discipline. That's the catch. Because index funds have their own psychological problem. They are incredibly easy to abandon. When your portfolio falls 30%, there is no tenant reminding you to keep holding. There is no building sitting outside your window. There's just a red number on a screen. And humans are very good at selling when they are scared. So which one builds wealth faster? Here's the uncomfortable answer. Neither one automatically wins. Because the investment with the highest theoretical return is useless if you cannot stick with it. Real estate can accelerate wealth through leverage. Index funds can accelerate wealth through diversification, low costs, liquidity, and compounding. Real estate gives you control. Index funds give you simplicity. Real estate can produce rental income. Index funds can produce dividends and capital appreciation. Real estate can use debt to magnify returns. Index funds usually don't require you to borrow hundreds of thousands of dollars to participate. And there's another massive difference. Scalability. The scalability question. Imagine David wants to invest another $1,000 next month. He opens his investment account, clicks a button. Done. Now imagine Sarah wants to buy another $400,000 property. She needs financing, a down payment, closing costs, due diligence, a property that actually makes financial sense, maybe months of searching. That's the difference. Index funds are almost frictionless to scale. Real estate is more operational, but real estate has another advantage. You can improve the asset. David can't personally make Apple more profitable. He owns the shares and accepts the results. Sarah can buy an underperforming property, renovate it, increase rents where appropriate, improve management, and potentially increase the property's value. Her actions can influence the outcome. That's a major difference between the two. The generational wealth question. Now we get to the part that actually matters. Generational wealth isn't just about reaching a certain number. It's about creating assets that can survive beyond you. A rental property can potentially generate income for decades. An index fund portfolio can potentially compound for decades. Both can be passed to heirs. Both can become the foundation for future wealth. So the question isn't, which one is better? The better question is, which one can I build consistently for the next 20 or 30 years? Because that's where the real advantage appears. Not in year 1, not in year 3, but after thousands of ordinary days of ownership. The hybrid. And here's something most people miss. You don't necessarily have to choose. You can own both. Imagine someone builds a diversified index fund portfolio with their regular income, while eventually buying one or two carefully selected rental properties. The index funds provide liquidity and diversification. The real estate provides leverage and potential rental income. Now you've created multiple wealth engines. But there's a warning. More investments don't automatically mean more wealth. Complexity can become its own form of risk. If owning 3 properties consumes your entire life, while an index fund portfolio would have allowed you to invest consistently and sleep peacefully, the more sophisticated strategy may actually be worse. The best portfolio isn't the one that looks impressive. It's the one you can actually maintain. The final test. So let's return to Sarah and David. 30 years pass. Sarah owns several properties. She has dealt with tenants, repairs, refinancing, vacancies, taxes, insurance, and plenty of stressful moments. But she also built substantial equity and potentially significant cash flow. David never owned a single rental property. He simply invested consistently. He endured crashes, ignored headlines, kept buying, and let compounding work. Both could end up wealthy. Both could leave assets to their children. Both could create generational wealth. But they took completely different roads to get there. And that's the lesson. You don't build generational wealth by finding the perfect asset. You build it by owning productive assets, adding to them, protecting yourself from catastrophic mistakes, and giving them enough time to compound. Real estate isn't magic. Index funds aren't magic. The magic is consistency. The decision, if you love negotiating, understanding properties, using leverage, managing projects, and you're comfortable taking on responsibility, real estate might fit you. If you want diversification, liquidity, low maintenance, and a strategy you can automate, index funds might fit you better. And if you want both, that's possible too. The mistake is copying somebody else's strategy without understanding why it works for them. A real estate investor might look at an index fund and say, that's too boring. An index fund investor might look at real estate and say, that's too much work. Both can be right, because wealth building isn't a competition between assets. It's a competition between your plan and your ability to stick with it. 30 years from now, your children probably won't care whether you became wealthy through a rental property or an index fund. They'll care that you left something behind, an asset, an opportunity, a financial foundation, something that gives them choices you didn't have. That's what generational wealth really is. Not looking rich, not having the biggest house, not winning an argument about real estate versus stocks. It's owning productive assets long enough and responsibly enough that the benefits continue after you're gone. So if someone handed you $100,000 today, would you put it into a property? Would you put it into index funds? Or would you build a strategy that uses both? There's no universal answer, but there is one mistake that almost everyone can avoid: waiting another 10 years to start. Because whether the asset is a building or a basket of businesses, time is still the most powerful thing you can put on your side. And once you understand that, the real question isn't which investment builds wealth faster. It's this: which one are you actually willing to own for the next 30 years?